Right, good morning, ladies and gentlemen. So wonderful for all of you to join us again for Boutiques on Wednesdays. And thank you all who joined us with the road shows or the conference last week. Some very insightful thoughts that came from that. And some may say, but I'm even more confused now than I were before. Do I buy more US or not? Some of these things we're going to cover in our discussions today as well. A great day for SA, or shall I rather say, a nerve-wracking day. Third round of the budget being presented, but more important, President Donald Trump meeting with President Cyril Ramaphosa in the Oval Office with a focus on how we can keep trade going with the US without a 30% tariff and possibly avoid sanctions. As Rob Hershoff puts it, will Cyril kiss the ring? What a deal, but it's needed to establish good relationships with the US and hopefully promote SA growth, putting SA first and not the ANC. Time will tell. I'm not even going to try to speculate on what the outcome is going to be. There's been numerous conversations going on in the background already, and the meeting could very well be just the epilogue. But with Trump, Rubio, and Vance in the room, who knows? This could have serious impacts on all assets in SA, even our inflation and interest rate cycle. But looking more to the US, some say US equities are still expensive and some say they are not. But in previous weeks, we've seen how managers diversified away from the US, and it worked well year to date, but strong recovery again in April. The decline of the dollar is also partly evident of that, with the world fears that the US will further weaponize the dollar and moving assets to things like gold and even other currencies like the Swiss franc or the yen. Notably, in Trump's first term, he focused on markets first, and the second half of his term, he focused on tariffs, and we all know about the tariffs war in 2018 to 2022. This time around, it's first tariffs, but some now wonder if we will actually move on to the line of getting markets right or getting the narrative right as he nears midterm elections in 2026. And there's a couple of things that they can still do to maybe spore on markets as well. With the rate cycle changing, what are some of the key tactical strategies that can be explored in both multi-asset funds and flexible fixed income funds? And some of those points we will explore today as well. With that, it's my pleasure to welcome our two presenters for this morning. Both of them very well seasoned investment professionals who comes with a wealth of experience in managing assets in both global and SA markets, with a strong background in financial advice as well. They speak the language of facing investors while managing investment solutions. And I think it puts them in a very unique position in terms of what they look at and how they see their funds. Joining us now is JC Lowe, co-founder or founder of Custodian Investment Management. And joining him as well is Paul Fouchier, co-founder and chief investment officer at New Road Capital. Good morning, JC and Paul. How are you doing this morning?
Very well, thanks, Eugene. Yeah, as you say, interesting day. So, lot to talk about.
Exactly. We are going to focus on your funds, how you see the world. And Paul, you're going to focus on a multi-asset fund. I think it's going to be very interesting. We've had you on a couple of times before. You've got some very unique ways in terms of how you construct a portfolio. JC, you are first, and you're going to have a look at your fixed income solution and where those tactical opportunities sit and how you bring it together in your fund. Tracy, thank you so much. I've got your presentation up. We are ready for you if you are.
Thank you, Jane. Yeah, thank you for the opportunity once again to present to the BCI crowd. We're going to quickly just touch, because we've got 15 minutes and I've been told 15 minutes only. We're going to quickly touch on fixed income and the levers you can use for your portfolios when selecting a fixed income fund, like an income fund. And the scenario we find ourselves in, the volatility, the turmoil. So yeah, we'll quickly briefly discuss. Who are we? We are a product-focused team with decades of experience. And I say product-focused because we work closely with the advisors and obviously inevitably their clients. So when you work with the end client or the advisor, we believe in keeping those products very simple try to remove all the jargon, and of course, just doing it well. So our solutions are built for the advisor, designed to reduce that expectation mismatch, which we'll discuss quickly, and obviously deliver constant performance or consistent performance for the advisor. So they've got a reliable, client-focused solution when they go visit their clients. To do all of this, you of course need to leave your ego by the door and keep things extremely simple. The fund in focus today is just the ASISA, it's the Custodian Income Plus. It's in the ASISA multi-asset income category. It's got a 13-year track record. It's about 1.7, 1.8 odd billion of AUM. It's a moving target. It is growing on a monthly basis, mostly thanks to the Raging Bull Award a couple of years ago. The fund includes a number of specialized managers, of course, in the same fund. So it's not a fund of fund. It's incorporating different managers and then obviously delivering that consistency that everyone craves. So we do believe putting the clients and basically in the best possible position without any compromise. And that's a very simple way to put it, but effectively you need to, by leaving your ego at the door, you need to go and say, am I the best stock picker? Am I the best cash manager? Am I the best bond manager out there? And if any of those questions are no, you need to make sure you employ the best. So I think that's the strategy we employ in our products. We would go out and seek out the best possible manager for the role. So we get focused, specialized managers for, let's say you need a bond manager, we'll get a fixed bond manager and a float, like we will discuss. And then of course we've got another fund as well, which you'll see. It's a Reg 28 balance fund. It's just a low cost ETF and tracker using fund based on our Salem model. And that Salem model, this is almost where you want to go, like in YouTube, where we go and say, hit that subscribe button. The Salem model we do on a monthly basis. We do the research to see what the top 10 largest asset managers or the largest balance funds out there do on a monthly basis, and they move month on month. We analyze it a bit, we write it up and show where the returns came from, and then we send it to our clients. Happy to send it on to the audience, and you can obviously just unsubscribe if you don't like it. So I keep managing these specialist mandates. Income funds should be simple. Income funds in turmoil, like we find ourselves now, or in interest rate cycles, you need to use your levers. And those levers are basically, do you want to fix your rates or do you want to float your rates? And when there's volatility, of course, you can take different actions and use the volatility. But brief explanation to the difference between fixed and floats. Now, float is probably the easier one to understand. A floating rate note would, as interest rates rise or go up, and let's use the repo rate, that's the one that the SARB will manipulate or use. As rates goes up, the floating rate instrument will literally float with that yield. So the yield in a floating rate instrument will actually pay you a little bit more as rate goes up. So that's the attractive instrument to own when rates are rising. And of course, when rates are climbing, the inverse relationship between a bond's yield, a fixed bond's yield, and its capital is key. So as yield goes up on a fixed bond, the capital must decline. So it's negative for the capital. So your investment will actually become worth less as yields will increase. So naturally, when you're looking at an interest rate cycle, when rates are supposed to go up, you want to sort of tilt more towards a floating rate as opposed to a fixed. And as the rates start coming down, your bonds will actually make capital gains as rates goes down. So that's the basics of an income fund and the allocation benefit you can get from altering your strategies. So in our case, we went and said, right, we would like the best fixed bond specialist out there. And Philip is widely regarded as, I mean, he would tell you that, but it's widely regarded as one of the fixed bond managers in the country. And it's not just his opinion. You can go look at his trophy case. He's got probably a Raging Bull every other year. He currently oversees about 21 billion in assets. And on the floating rate side, again, Paul and Louis need no introduction. They're just as good. If you look at their trophy case, they probably have every other year's Raging Bull as well. So combine the two and you probably have the entire series. But these are the two specialist managers we employ in our fund. to make sure that we are well positioned when we need to be. So understanding this interest rate cycle is obviously the key to delivering that sort of low risk, reliable income. And that's why we deploy these guys. Now that we have them, let's have a look at how you should do this. You as the advisor should then go and say, right, where are we? In what environment do we find ourselves? Now, focusing on the current environment we have, tariffs, the trade wars, the political instability, and we all know what's going on. But in SA, we've had a very sort of volatile. Our bonds had a very big sell-off. So the capital lost and the yields spiked, and almost just as quick, it recovered again. The rand went nearly 20 to the dollar. The rand is now sub 18 again. So we've had a very weak period followed by a very strong period, and that's just basically volatility. And to get a view from our two managers as we stand today, Philip is the flexible, call it bond manager then. He believes that active management remains the critical component during this sort of volatility. With longer dated bonds, we put out a lot of information on Twitter as well. But longer bonds are offering inflation plus 9% at the moment. And that's CPI plus 9 is equity fund benchmark targets. So he sees a strong potential, obviously, to lock in these returns, these yields at the current levels. And although the portfolio is already overweight fixed bonds in his component, he's still well positioned to adjust dynamically to it. And he's confident that with this volatility, this sort of buy low, sell high strategies everyone always promote, volatility just creates opportunity. In contrast, Louis has probably had a very boring period as a floating rate manager because rates haven't been adjusted. Typically, floating rate or credit is issued by a corporate. So this volatility just said, listen, we'll wait and see. We'll see how this plays out. We're not going to issue bonds at or instruments at elevated levels. We'll just wait a bit. So almost all the credit spreads and movement of the credit spread was happened overseas, not in SA. So having that sort of blend of the boring bit that Louis now oversees and the exciting volatility that Philip can utilize, that's where the benefit of this fund and the combination of its managers come in. So just looking at where we are in the current cycle, very briefly, you'll see the inflation rate is at sort of the brown line. And I want to point towards 2003. You can see inflation picking up from nearly 0 all the way up to 14%. And you can see the blue line, the repo rate, start to react towards rising inflation. So you can see that inflation is actually a sort of a precursor to what the repo rate would do. And then in 2008, when inflation sort of peaked, the repo rate, as inflation sort of declined again, the repo rate could follow. So looking at where we are today, since 2022, we've had inflation that's been dropping from a rate of 8% down to closer to 2% per annum, while the repo rate has stayed unchanged. So if I was a betting man, I would look at that and say it's a big crocodile jaw that's opened up in that blue circle. The likely move on the repo rate is probably going to be lower. So we're all anticipating and expecting rate cuts, and those rate cuts would be positive for fixed bonds that could make capital gain as opposed to floats. So naturally, you want to look at your portfolio and say, right, you maybe want to tilt. So is that the only risk? Well, if you can measure it, you can manage it. I think the textbook will probably tell you it's losing money. For us, we see the advisor using income funds or income allocation as a cash bucket. That cash bucket is, say, he's going to set aside a bundle of money for the next 5 years, and that money must sort of grow by 8% per annum. He works in inflation, but that pot of money must grow at 8% inflation. If we, after 5 years, only delivered 7, there's a big problem with his planning because he'll have to dip into his growth bucket. And that's for us is quite an important risk. And to get that risk out of the way, we need to focus on consistency and predictability. And to get there, we believe there are 3 main risks that you as the advisor should consider when you're buying funds like this. Now, counterparty, the risk of something you own going into distress, like whose brand do you own? Do you own government? Do you own a corporate? There's also duration, and very quickly in terms of duration management, the longer you go in the bond spectrum. So a 20-year bond would have a lot more risk than a 1-year bond because a lot more can happen in it. There's a multiplier in effect in duration. So You need to know what your duration looks like in your fund, and then of course liquidity, being able to buy or sell what you own. Now, counterparty risk is like a wordy slide, this one, so you can read it afterwards, but broadly defined, you've got like guaranteed type bonds, and that's basically government. It can be fixed or floats, but government will issue, and that's government guaranteed. Then you've almost got like an implied guarantee, where you've got like Eskom, and Eskom won't be allowed to fail, let's put it that way. So the government will step in to help it because it's something that's critically important to the country. So it's like implied. It's not quite guaranteed, but there should be some support. Then you've got the top quality, let's call it the big five banks. If one of them fall over, you need to run for the hills anyways. And then you've got obviously lesser quality with no guarantee. Duration risk, easy to see the impact that Philips had on our fund. We track monthly basis in terms of what the peers in the industry are doing. Are we sort of in the forest, or are we sort of an outlier? And you can see us sort of in the mix. More importantly, on the right-hand side, you can see the fund's duration is close to 2, while the all bond index is close to, call it 5.5 to 6%. So we're roughly at a third of the duration of the bond index, yet our yield is still at about 10.3. So very attractive duration management, but you need to make sure where you are compared to your peers, and then liquidity management, not even having to touch on it. We break down the fund saying more than 90% is in highly liquid, daily priced, daily traded instruments, which we are sure of we need to liquidate or buy. So the category is a low risk category, and you can typically basically just set up an income bucket and you buy and hold, right? But just remember to check out where in the economic cycle you find yourself. So what type? Do you want to buy a bond dominated or a floating rate dominated fund? Remember, that's now for 5 years, so you probably need to sort of chop and change that income bucket as well. What mix or allocation do you find yourself? Is it a 50-50 of that fund? Is it a 60-40, etc.? Then who are the managers? Are they proven managers like we've selected to manage those allocations? So has the manager got the capability of managing that allocation for you? Then what or who's inside? Who's your counterparty? Do you own rubbish or do you own government? What's the duration of that stuff that you bought? I mean, your bond manager can come back and say, bought you some bonds, boss. Well, wait, is it a 1-year bond or a 20-year bond? There need to be some details. And then, of course, the instruments that he bought, can we get out of it if we need to? So it's like that shampoo bottle says, wash, rinse, and repeat daily, weekly, monthly, quarterly. But is that your job, though? Or you can just leave it to guys like us with a proven track record, who does all of that in one fund. So what does the consistency type look like? We look at the fund, 1, 2, 3, 4, 5, 6, 7 years, all first quartile versus the sector since inception. First quartile annualized returns, first quartile in terms of risk, and first quartile naturally the Sharpe ratio. And the returns, we did mention that we had a decent 1 year, but you can also see versus the sector and cash. It's been a very good time for bond-orientated funds, and that's why our tilt at the moment is also leaning more towards fixed bonds with a real rate of inflation plus 9. You'll be silly not to. And then to wrap up quickly, where can you find these? Besides BCI's platform, all the major lists on the income fund, and of course the balance fund, similar, all the major lists, and very soon will also be at Anacray. And being a BCI seminar, I need to show you the disclaimers. I read quickly. All done. Thank you very much.
Josie, thank you very much for that. Very much to the point. The answers in the numbers, I think. But please stay on the line. I've got a couple of questions from you. 1 or 2 coming in from the audience as well. Paul, you up next. Thank you very much. Your slides are up and running already. We're ready for you.
Great. Thanks, Eugene. So we're going to talk about, sorry, excuse me, I've got a little bit of a cough going on, but it's quite cold in Pretoria this morning. But we're going to talk about our Enhanced Opportunities Fund. It is our flagship fund. All our funds do cover similar sort of positioning across the risk profiles, but really look at our Enhanced Opportunities Fund as our sort of flagship. It's a high equity mandate. Just to look at some performance, I like to talk about performance before we get into the charts. If you look since inception, quite well above benchmark. The fund now, it's a fairly young fund still. It's 2 years and 4 months old this month. but already showing very good returns since inception. The fund has just reached assets of 1.1 billion, so doing very well, particularly in the advised space. Got a TRC at the moment, so that's all in costs, including trading costs on platform at around 1%, just under 1%. So from a cost point of view, very good. And we're really trying to cater to that advisor base. If you look at the last 1 year performance, we are trailing slightly. This is at the end of April, trailing slightly, and that's really the subject that I'm going to talk about today. It's due to our holdings in US equities. We do have a significant upweight in US equities, which we still think is where you want to be on the global space. It's the most attractive looking sector of the market, we think, and we'll get into that. But even if you look, which I'm not allowed to show you, but even if you look through May, where we are now, we're already significantly above this benchmark over a year again. But obviously we can't show you intra-month numbers, but I can talk about them, I suppose. But yeah, you've already seen a huge rebound in US assets. Definitely, we think, the volatility that you've seen in US assets since the beginning of the year, really overblown. We think it's an overreaction. So getting into the numbers and where we are, or getting into the economic preso. I'm just putting things in context. So we've already seen a big rebound in assets, and what we did here is we compared the 2020 S&P 500, so that was during COVID. That's the blue line, to the orange line, which is now the sort of Liberation Day sell-offs, the tariffs, things like that. And what you got to remember is the market will always climb a wall of worry. That's what it does. If it doesn't climb a wall of worry, you should get out of the markets because you're in some kind of bubble. So always remember that. We've already seen the sell-off, and the same saw it through COVID. And if you remember through the COVID recovery, and the reason we use COVID as is just the most recent sell-off in our memory. But throughout this whole period, this phenomenal run in performance, there was worry. There was concern about, what's happening to the global economy with shutdown and the economy, what's happening with COVID, new strains coming out. There was a lot of political noise going on at the time. You had a lot of from various factions. There was aggression on the streets. There was a lot going on. But through all this time, the market just continued to chug up, and we don't see how this would be any different, and it's never been different at any time in the past. Historically speaking, dips have always been good opportunities to buy equities, and we think with the US particularly being hit the hardest through this, it's no different this time around. So just something to remember. Just getting onto the tariffs, and really, investing is about looking forward. It's not about reacting to what's already happened. And our thesis is really the talk around the tariffs, the talk around Liberation Day, what Trump is trying to do. You've really got to understand the man before you can understand the policies. And I think advisable to anyone to read some of his books, particularly his book on the art of the deal and how he views essentially negotiation. He's very transactional as an individual, and it's very important to understand what motivates him and how he works and how he thinks. Now, if you look at the Liberation Day tariffs, our view, reading a book like The Art of the Deal, it's really about one thing. It's about setting up and whether you agree with them or not is irrelevant. The point is, it's about setting up a position of strength and then negotiating from that position of strength. So, our view is that those tariffs were never meant to be permanent. In hindsight, that has been the case. You've seen the tariff pauses coming through, and now you're having negotiations coming through. And that's very important to remember. Anyone who considers these tariffs to be permanent and that's going to be the status quo going forward, I think is missing the message here. So very important to understand that. Now, getting into what's really happened, you had the first tariffs initially. This is just a kind of runway of what's been happening, and this has really been the reason since January why US equities have been under pressure for the year. But then why they've recovered so strongly through sort of end of April and into May as well. You had the tariffs on Mexico, Canada, and China kind of being imposed here. And then you had the sort of big Liberation Day announcement that caused that big sell-off in equities. Literally a week later, you saw a pause there. Now, what I think here, and this is very important, if you're going to take out anything out of today's presentation, I think it's this, is that I think Trump's initial plan was to put on the tariffs, as I say, set up that position of strength and negotiate from that. I think his original plan was to impose the tariffs, hold the tariffs. So you had that 10% base tariff plus the sort of individual reciprocal tariffs, as they called them. Hold those tariffs until they started to negotiate. And I don't think he foresaw the impact that it would have on the equity markets and the bond market, in fact, in the US. I don't think he foresaw that. I don't think anyone really foresaw the extent to which that sell-off would happen. But the key takeaway here is that Trump pivoted. Now, he's not going to admit in public that he made a mistake, but he's acting like he's made a mistake. And for me, that's good enough. I think a lot in today's day and age, a lot of global leaders, you see it in the global stage, you see it in politics, you also see it in the corporates a little bit, is that they are too scared to pivot. They're too scared to change their mind. They see it as weakness. So we've been kind of sold the story that if you're not decisive and you don't follow your ideology into the ground, you're seen as to be flip-floppy, you're seen as to be a weak leader. And I think there's also an element of pride that comes into that. So you see a lot of global leaders following kind of ideology all the way down. And I think that's actually a strength of Trump. Trump is not ideological at all. He's very pragmatic. He's very happy to pivot. He's very happy to change his tone. And he's not scared to try something and see if it works. And if it doesn't work, to change his tack. And I really think that's what happened with this 90-day pause on the 9th of April. As I say, I think his original plan was implement the tariffs and then negotiate. But when he saw the market got hit, he said, okay, well, wait, we better maybe let's put a pause on and then negotiate from the pause. We've still got the overall arching threat of the tariffs after 90 days. I still create my position of strength, but we can't really tolerate the sell-off we've seen in the markets, and that's not good for what we're trying to achieve long term. Remember, Trump's goal long term, he actually wants to leave a legacy. He wants growth. He wants good performance over the next 4 years. So just remember that. That's, I think, the most crucial thing around this is Trump is not scared to pivot. If he tries something, I'm sure he's going to, there's a lot that's going to come out in the next 3 years under his administration. Remember that he's not afraid to try things and then turn around if he needs to. Now, he's not going to admit he made a mistake. Okay, he's not going to come out and say, I made a mistake and that's why I put the pause on. He's going to tell you that it was planned all the way along. But it doesn't matter what he says. What matters is what he does. And what matters is what people do, not what they say. So very important and something to remember, I think, is crucial. Since then, we've had a lot of trade deals coming out. And why we think this market is still why we got legs, and particularly in the US, is that forgetting about all the rhetoric around politics, around the trade deals you're going to see on the media and all that, ultimately, we think the majority of the news coming out around tariffs going forward is going to be positive. The bad news is baked in. We've got the implementation of the base tariff and the reciprocal tariffs that are due to come back online in 3 months. But all the announcements you're seeing come out going forward have been good news. It's all about trade deals. And that was the plan all along. It's about how do we set up trade deals, beneficial trade deals with various nations going forward. And that hopefully can be beneficial for both sides of the equation. So you've seen, 12th of May, a month later, China and the US announcing a truce. Now, if you looked at the media, that was never on the cards. That was never going to happen. Suddenly, out of nowhere, you've got a truce there, and you've got what looks to be like pretty good negotiations happening on that side, and probably you're going to see some positive news coming out of that. Trump's just done his golf tour, very positive news. As you know, we like tech. We still like tech. We actually like tech way more now than we did in January. It's a lot cheaper now. We've been buying some into this dip. The tech sector, what the Middle East is going to invest in towards the tech sector in terms of data centers and things like that, massive going forward. We think very, very positive. And so far, according to Scott Bessent, who's the US Treasury Secretary, 70 countries have called so far to negotiate, including South Africa. And South Africa's got their meeting, it'll be this afternoon on our side. And it'll be interesting to see what happens. Now, look, I'm not, I think most of the news is likely to be good news globally. I think for any sort of large economy, Western economy, sort of neoliberal type economy, I think there's going to be positive news. I think most countries are going to come and want to work with Trump. There are going to be the exceptions to that. I'm not convinced that what's going to come out of our meeting specifically today, I don't think you're going to see I don't think it's going to be like what you saw with Zelensky or anything like that. I think Ramaphosa is a much better sort of public persona than Zelensky is, but I don't know that we can offer them, or that the SA government is willing to offer them what they're looking for in terms of any trade deals going forward. So I think question mark around South Africa, but another reason why we like offshore and we like the US. But I think globally, a lot of good news is going to come out of the tariff story in the main. Just on the tariffs as well, tariffs in Trump's first term were not inflationary. And we don't think that even if that base tariff of 10% stays on the cards, which it's probably likely to happen, we don't think that's going to be particularly inflationary going forward. You could argue that the new inflation or the new tariffs are a lot more widespread than the old tariffs, but the old tariffs weren't inflationary at all. It's not like they added a little bit of inflation. In the main, deflationary, really. I mean, you could see into COVID, there was virtually no inflation. So, we don't think inflationary, and the numbers back us up. So if you look at the last numbers that came out of the US in April, a lot of economists are going, April is the month, that's the month that's going to show the tick up in inflation. We've had a couple months worth of tariffs now. This is the number that you need to look at. It's going to change the future of the inflation trajectory. The number came out below expectations. So expectations were for a month on month 0.3%, came in at 0.2% seasonally adjusted. If you convert that into an annual inflation rate, the expectation was a 2.4 and it came in at 2.3. So the previous number actually, so March to March was 2.4 and it actually came in below that. So kind of leaning into our thesis around we don't see even the 10%. We think it's going to be absorbed by the businesses. We've got impending tax cuts coming as well that we think there's going to be an offset. You got to look at all these policies. You can't look at them in isolation. There's a tariff agenda, but there's also a tax cut agenda on the other side. So you got to kind of weigh the balance on these things. But still, the vast majority of inflation in the US, of the 2.3%, 1.3% of it is what's called owner's equivalent rent, which is actually not a real inflation number. What this number is this: they call people up, they call homeowners up, and they say, or people who are leasing their properties on, they say, how much are you going to put your rental up? If you could put your rental up now, how much are you going to put it up by? And that number is a very lagging indicator on inflation, because obviously if you're called up and inflation's sitting at 10%, and I ask you, well, what you're going to increase your rental by next month, you're going to say 10%. Inflation's at 1%, you might say, what, maybe get greedy and say 2%, but you get my point, is that it's a lagging indicator of inflation. And if you take that out, and it's not a real number, it's not actually what people are paying. What people are actually paying in rental is this number here, rent of primary residence. But this is just a number to get an idea of what people are thinking about how they're going to increase their rates, their rental rates going forward. If you carve that out, there's no inflation. Energy is actually deflationary. So if you look at another part of the Trump policy and why we think, don't just expect high inflation, is he wants to liberalize energy. I mean, one of the main reasons he's been in the Gulf and he's been talking to Saudi Arabia is very aware that they're not going to be able to wring the neck out of oil anymore. I mean, Trump wants to make the US energy independent. That's going to have an impact on those economies that are relying on kind of energy dependence that has been the sort of norm for the last 20, 30 years. So you're seeing huge pressure on energy. You're seeing, so we believe, energy costs are actually going to continue to be deflationary, maybe even more so than they have been up till now. And you've got to incorporate all these things when you look at these things, and not just look at sort of one component of this entire administration's policies in isolation. Very, very risky job to do that. If you take out shelter and the inflation number, just another chart, you can see some inflation at 2.3, very close to the 2% target. Take out the shelter, there's virtually no inflation. So we still foresee rates coming down in the main. I think, Powell, in terms of where he isn't with the Treasury right now, I think there's a fear that you're going to see this inflation coming through. So I think rates will probably stay higher than they need to be for longer, but definitely not raised. I think you will start to see them come down in the main still, which is good for assets just generally. It's good for bonds. It's good for equities. And then what I was talking about, the tax cuts. So, we've still got this impending tax bill. They call it the One Big Beautiful Bill. They are Americans after all, so you gotta have a bit of marketing and ceremony in there. That bill is proposed to offer quite significant tax cuts through the American economy, and we think that's going to offset any effect of the tariffs that lag once you've seen all this good news come out on trade deals. I think will be undercut largely by the continued savings and taxes as well. So and then you've also got the energy coming down. So these things all tie into each other, and you've got to look at like the whole scope. Just on valuations in the US, the PEG ratio. So this is the S&P, so the forward PE over the next 5-year long-term expected earnings, basically. So obviously if you've got expected earnings higher, you can have a higher PE because your earnings should kind of account for that. And currently sitting at not very much above the average it's been over the last 20-25 years. You've seen it moves around here, but from a valuation point of view, if you look at the S&P 500 and you scrap out all the noise and you just So what's the PE versus the expected growth rate? Pretty average, actually. So it's not like a screaming, it's not very cheap, it's not very expensive either. But we actually think growth might surprise to the upside during this administration's term. We think that Trump is very willing to pivot. We think he's going to try things. There's going to be a lot of noise. The media is going to react the way the media tends to react to Trump. But you've got to kind of look through that, cut through it all, and really look at what's on the table from an investment point of view. Last, I'll be a little bit facetious and just kind of wrap up why we like the US still and why we've been buying assets into this dip. I was recently in the UK on holiday. Took my family to the UK, and I don't know if any of you have been to Europe lately, but there's this bottle cap story now where you can't get the bottle cap off the bottle because it's a recycling. Apparently the bottle caps aren't being recycled enough or something. I'm not actually quite sure what problem it's trying to solve, but ultimately you've got this innovation that's come out of the US, and if you look, the US, Jensen Huang from Nvidia, a stock that we love as well, just launching his new chips out there. And you've seen the massive investment that Saudi Arabia and Qatar are going to put into this. And you've got massive investments, Taiwan Semiconductor coming back onto the US or starting to build a plant in the US. And that's innovation. That's where you want to be as an investor. You want to be involved in innovative businesses that are going to make money for the next 10, 20, 30 years on innovation and human development and human progress. But I mean, if you look at where Europe is at the moment, they've been able to innovate the sort of detachless bottle cap from the bottle. So I am being a little bit facetious. I'm sure there's more to it than that, but just kind of paints the picture of why we still prefer the US. You want to be with the innovators. You don't want to be with the regulators. And that's very important from a long-term point of view. So that kind of wraps it up. I know we only have 15 minutes. I have gone a bit over time, but thank you anyway. Thanks for your time, gents and ladies.
Paul, that was perfect. Thank you very much for that. Paul, I'm going to stay with you while I've got you on the line. I see Josie's still on the line as well. A couple of questions from Josie. But Paul, let me start with you. And you did touch on, the tax reform or the tax cut that's still in the pipeline for the US. But there's a concern with that. Yes, it's going to stimulate the economy. And I do think that the US consumer is possibly not as strong as what they were a year or year and a half ago. We've seen Doge. I mean, it's a bit of a flop. The $2.5 trillion that they would have saved or cut out of expenditure is not there. It's adding up to a couple of 100 billion. It's still savings, definitely, but not nearly as much as they need to save. And if a tax reform or tax cuts comes through, I mean, that's a bloody big bazooka. That's just going to add to US debt.
That's
and
the
they're
that's
possibly
this.
not going to raise. They're possibly not going
Yes,
to raise all the money that they raised from tariffs. We're probably going to see tariffs ending somewhere around about 10%. So it's not going to prop up that hole. The spending cutting is not as successful. Where's the US going with debt?
Yeah, that's a valid concern, and I think it's a sort of big one that's been raised. I think where people are maybe underestimating the potential for tax receipts is in economic growth. So we actually think economic growth is going to be stronger. You're still going to have your ups and downs, but I mean, in the main, we think it's going to be stronger than what's expected. So we think that peg rate that I was talking about, we actually think growth might come in at a bit higher. And the majority of taxes are collected through economic growth. We're seeing the same problem in South Africa. We've got this continuous fiscal issue. There's one way to solve it: grow the economy by 4%. You solved it all. We keep trying to take more of the pie, just grow the pie. And I think that's something that hasn't been factored into to as much of an extent as what I think it should be. So yes, that is a concern. Look, you've also got to remember, historically speaking, the US has not been fiscally prudent for the last 30, 40 years. Their debt to GDP has continuously risen pretty much unabated for the last 3 decades. If it continues to go into that trajectory, I don't foresee it to be, I don't think I actually think you'll probably see some fiscal improvement just through growth. But let's assume that doesn't happen and you consider to see this debt go out of whack. I don't think in the short to medium term that that's going to be a problem for the US. I think the US is still able to raise a lot of debt to cover a lot of debt to cover impending payments. And there's still a lot of trust. Although you've seen this sort of narrative around trust in the US financial system under pressure, that's a lot of nonsense. It's a blip in the radar. We don't think much changes on that. So we're not too concerned. We think, I mean, if you look at like China or Japan, their debt to GDP is way higher than the US, and they're not the global reserve currency either. So it's something to look at, but we don't think it's like the make or break here. And I mean,
Quick question coming.
I suppose bottom line on that too is, it's funny how the sort of left-wing media is talking about fiscal prudence all of a sudden. It's something they haven't practiced for years, but now suddenly it's a big issue.
Question coming in from the audience. I can't see how tariffs cannot create inflation. For example, 10% increase in prices, surely that's going to be inflationary.
Well, if you absorb the cost in your own business model, you're not going to pass it on to the consumer as much. So if you can save money, for example, on tax. So let's say you sell a product for $100 and it costs you $50 to make. Now it suddenly costs you $55 to make because you've got a 10% tariff on it. Okay, let's just for simplicity's sake. You could, if you get a 5% saving in tax, you kind of in the same place that you were before. Your net margin is actually the same.
So companies that absorb those costs into their margins are probably going to sit with less earnings and slower earnings.
Well, the net margins their operating
concern.
margins might be under pressure, but the net margin hopefully will be quite good. And then another thing is also competition. Innovation. Innovation is this kind of been, we don't talk about it enough. It's been this deflationary force for years. Just think about your experience as a consumer. Just think of the cost of I'm not talking about after COVID, that like ring fence that was just, bad policy, but think of the last 20 years and your experience as a consumer. Things in real terms have gotten cheaper. Why? Inflation. Innovation. We think that force is still very much in vogue. It's also why we like tech. An increase in technology tends to be a deflationary force globally. So, it's not just a case of looking at one isolated thing and saying, okay, well, if an input cost goes up, then inflation's going to go up. There's a lot more to it. Also, even if that was the case, let's say you had an increase in an input cost that's going to give you an increase in, let's say everything just got passed through and there was no change to any underlying economic consideration. That wouldn't be inflationary, it would just be a price shock. Inflation is constant moving up of prices. So, if the cost of apples go from 1 Rand to 1 Rand 10, but then they stay at 1 Rand 10 for 5 years, inflation is not 10%. Yes, there was a jump there was a pickup of 10%, but it's not this long run inflationary adjustment. So you've also got to distinguish between inflation and inflation shocks, which are not the same thing either. But even having said that, I still don't think it's going to be there's going to be much pressure to this. Well, it wasn't.
Thanks. I'm gonna.
Yeah,
I think let's park
it
there. I want to get a little bit more detail on specifics on your fund. But before that, we do that, JC, let's talk about your fund very quickly and your presentation and some of the questions coming in from the audience as well. Is trying to understand the fund a little bit better. Let's maybe start with the principle of this is a multi-managed solution, but it's not a fund of funds, it's a fund. So how exactly do you structure the fund?
Yeah, it's a good question, Eugene. It's exactly that. It's the client pays no more. There's a TER or there's a fund management fee on it. It's a single asset. So if you look at a Morningstar or a system that gives you the breakdown of what's inside the fund on a quarterly basis, you'll see very few funds. There will be funds like money market funds, like BCI's money market fund, etc., which we use for floats. But effectively, you can see it as I'm sitting basically on the capstone of this pyramid. I need to allocate who gets how much in terms of the allocation. And then you've got co-managers, say Philip and Louis, who will run the strategies. Now, when we say it's co-managers, the mandate you'll see that the component that Philip managed for us is not the same as he would have in his own fund. We would give him different guidelines. And I think that's why probably if you were to go and say, well, I'll just go buy them 50-50 in the background, you're not going to get the same results. It might be better. We don't care about the upside. We care about the risk adjusted. So the mandates will be slightly different. And I think also people need to know that we see the entire portfolio at all times, daily, like real time. So we would have a float which we'll allocate to the managers. We would have our own component in money market, knowing that there's some yield to be had, etc. But when we give a mandate to someone like Philip, we'll go and say, Philip, please keep the duration for the entire fund below a certain level. Your SEGI or your component you manage is only allowed to have, say, 4 duration or something like that. And it becomes far more important when you look at the credit or the floating side of things. We prefer to have, I showed that slide with the liquidity, we prefer to have far greater exposure towards guaranteed government, SOEs, and the larger banks. We would have very, very little exposure to anything below that. Liquidity is important. So we want all our instruments to be traded and priced. And that's the big thing. Not all instruments are priced daily. So the instrument in your fund might actually have a very old price to it because it hasn't traded since then. I know they're supposed to market, but they just don't. And I think then obviously once you manage that, and a very topical thing that's now at the moment is we saw late last week that one of the rating agencies said Transnet doesn't have enough, or has got enough float for another 3 months, then it's bust. You immediately, as the advisor, you need to take a step back and say, right, which of my income funds in my solution owns Transnet exposure? Well, spoiler alert, all of them. But how big is it? Is the risk or the positioning of that instrument or that exposure to Transnet, is it manageable or is it big? Is it 10% of the fund or is it a quarter of the fund? You need to know these things. That's why look through and drill downs into these portfolios real time daily is critical. So we know for a fact what the exposure to each counterparty is, what the duration of the fund is, and we actually narrow it down a bit. So we become far more predictable than what a raw or just a dedicated bond fund would be, for example, compared to our fund. So it is very much a co-management. We speak daily, and we'll be offered, listen, I'm looking at this instrument. Do you want more of it? So, no, we've got enough in our fund. We'll skip this one. So yeah, it's a co-management, not a fund of fund.
And I think very important to understand that because it's very different to a typical multi-managed solution where you just chuck a couple of income funds into a pot and hope they work. It's on a look-through basis, so you have far more control over the outcome. And the proof is in the pudding. I mean, you've showed those numbers as well. Let's talk about things like credit very quickly. You refer to Paul and Nui, they're from Fairtree. We're all familiar with the Fairtree BCI Income Plus Fund and the solutions that they offer. But if I look at their fund or the exposure, yes, they've got the European exposure, the currency is hedged out. We all know about that by now. And European credit still trading at very attractive levels. But SA credit, and I mean some of the banks trading below nominal bonds. What's your views on SA credit and what's that exposure in your portfolio?
I think you can have a view. I agree with you completely. I also saw those that I think Philip presented it during your seminar a week ago, just showing you're no longer rewarded for the risk you carry in the underlying. So just a quick explanation. If you're a bank, you can. There can be a struggle. If you're the country, you're far less likely to have a credit event or an issue. So if you can have an issue or an event, you should pay a premium. So a bank, for example, should be paying you more than what the government would pay. And that at the moment is not happening. And then there's also instruments like AT1s and Tier 2 capital, etc. Those things on the credit front, they listed around 4, maybe 5% above what you can get in the bank. And those instruments have sort of the gap between the bank and that instruments have continuously shrunk. People are willing to buy it and own it. But that's where the risk lies. It's when the corporate or the bank cease to pay interest, it's just not going to pay. So AT1s, tier 2s, those kind of sort of products in your fund should also be limited, especially now with the spreads being that narrow. And I think that's where Louis comes from and says, listen, there's just no attractive new issuance, because as a thing has got duration, you list it as, say, 4% above cash. By the time it expires, it's got to be at cash, kind of the spread will narrow. So you'll get that benefit over time. So if there's no new instrument, you're not loading any new attractive instruments in that's going to help and supplement your fund going forward. So it is a dynamics of knowing what instrument to put in now. Is it attractive enough over time compared to what you can buy elsewhere? But a way easier answer to your question is, when you can get inflation plus 9% in a government bond, why are you looking elsewhere? So if your mandate allows 60% bonds or 80% bonds, you should be nearing the max of your allocation towards that risky bonds. Now, again, risky in bonds is duration risk. It's not counterparty risk. It's government. So the credit or the guarantee type risk is very low. It's just got movement. So it's got duration and volatility. So you need to manage that carefully. And that's why our fund is running at roughly 2 duration, just to manage that. But we're going to load in as much bonds, SA fixed bonds we can find at these sort of elevated yields.
And I mean, with high rates for longer, yes, there might be 1 or 2 rate cuts, but your reinvestment rate also remaining very attractive. So it puts fixed income solutions, I think, on a very good foot, not only for this year, but possibly for the next 2 or 3 or maybe 4 years. Paul, I mean, on that conversation, exactly that, a lot of clients asking that if I can get, inflation plus 4 to even 9% from SA bonds, why bother with things like, especially SA equity? If we don't feel very good about SA, we'll see what happens today. Why not just load up a lot more on bonds?
100%. That's something we grapple with all the time, and I agree with JC. We actually own predominantly SA Govie bonds rather than credit, just because volatility's not really a risk. You can view it as a risk, but we more view it as the cost of liquidity. Actually, that's the cost of having a liquid instrument is volatility. So just remember that you're benefiting with liquidity, but you're giving up in volatility, if that makes sense. A lot of these credit instruments, when there's a credit risk or when there's a liquidity crisis, you can't get out of the things either. So something else to think about. But yeah, we agree with JC on that. In terms of how that pairs off with SA equities, we are pretty much we actually have a higher weight to the bonds than the equities. We don't see where the growth is coming through in terms of the SA economy. So with the nice thing about the bonds is you don't actually need a lot of growth. We can carry on at 0.5%, 1%. You'll get paid your coupon. But if you want to make 20% in the equity markets, good luck at 1% GDP growth rates. So we kind of agree with that. We do hold equities for diversification purposes, but we're pretty neutral. Actually, in our fund, our look through on equities is top 50. We track an index. We don't think there's any sort of obvious kind of innovative market leading businesses out there that are worth owning outside the value of the level of the index. But that's really why we like the US. It kind of talks into what we're talking about here, is that the reason we own US equities is because we think you're going to do a lot more than inflation plus 4 or 5. There's still a lot of innovation there. You still got potential for an economic unlock there. You still got very good demographics there. The culture lends itself very much to entrepreneurship. And that's why we like it. We'd rather get our equity exposure in a place like the US rather than South Africa. Absolutely. But the bonds are very attractive. So you've got to put them in your portfolio.
Thanks, Paul. JC, you want to add to that?
Yeah, I've got the little hand up. I did flash the disclaimer very quickly. I hope you took a screenshot. But so this is not advice or something like that, but it might be controversial. You've got a number of good hedge fund partners available for investment. And I think when you look at SA equity, it's done very well year to date. Relative performance, absolute returns, it's done very well. So I think you can actually consider, I'm not negative on SA as we stand, but in terms of a relative returns, where you can get returns from for the amount of risk you're going to take, I think to switch equity into hedged equity in SA is not a bad play. So then you don't concern yourself with the direction of it. You've got good managers looking after it. Or alternative products, in my opinion, like something like a portable alpha type structure that uses yields and interest rates to give you equity exposure, but you also get that as yields lower, you could get an extra kicker. So there are a number of structures or call it fake equity. So using trackers, for example, in our balance fund, you can use an ETF, or you can use a tracker, or you can use something like Portable Alpha that a number of companies can offer. And it's just simply put, they'll buy exposure to the market using options, and they'll fund it with some funding, like a spread. And because they can earn interest more than what they pay to finance this thing, let's say they have to finance with a daily rate of 7 or 8%, but you can invest in a 11 or 12% bond with the remaining of the cash. You can actually get a little bit of an interest turn on top of your equity return. So if you're clever about it, and it comes all the way back to leaving your bloody ego at the door, you don't have to be better than the market. There are brilliant instruments out there, and replace your the top value or growth manager out there, and just replace it with a good tracker that can actually give you a yield enhancer or a kicker in the end of the year. It requires you to be bigger than that and say, right, this is a good product. Let's just step back from what I would like to do for myself. So there are alternatives at the moment, but yeah, to consider.
I can hear the active guys shouting and say, but this is a time that you actually need to be a lot more selective in terms of what you buy. But I'm going to park it there. And on that note, on hedge funds, to our audience. Yeah, well, exactly.
I'm going to say good luck.
The world is changing, or is it not changing? On that note, I mean, just a reminder to our audience, we've got a hedge fund webinar going tomorrow morning from 8:30 until 10, so that should be very interesting. But on hedge funds, that disclaimer again, just make sure that you've got the right license. Paul, very last question. The clock is chasing us down here, but it speaks to your offshore holdings. You've always, the last time you spoke, you had a healthy exposure to global bonds. You still have a healthy exposure. I think it's very different to a lot of portfolios that we look at. Do you see that as an investment opportunity, or is it a hedge against volatility, or a bit of both?
Actually, at the moment, we think both. So we've actually sold down some of those treasuries to buy equities in this dip. So it held off. It didn't do as well as what we thought it would do, but it didn't sell off quite nearly as much as the equity market. So it did provide some protection in the portfolios for us, and we actually took a lot of those treasuries and bought equities through the dip. But we still have a fair amount of them, and we think there's an opportunity now there as well. You know, our thesis holds true that we don't think inflation's going to be nearly the kind of numbers the market thinks it's going to be. We think that there's a lot of capital. You know, I mean, we specifically own US Treasuries, and US Treasuries right now are giving you, you know, close to a 5% yield in dollars in hard currency. That's, you know, when you take the, you know, probable future rand weakness over, I'm talking about over time, another 3% a year, talking 9% in rand returns on those. So it's just on their own right, not a bad investment. But if you add capital return to that, you know, if you know, yields go from close to 5 down to 2 again, you're going to get a massive capital uptake as well, and that could be quite powerful. So we like them for diversification reasons and hedging, but we also think they're actually investable right now. And it's the first time they've been investable in, you know, decades. So, you know, you've got to start looking at them in your portfolio and not just ruling them out. And they do provide very good opportunities. So I think in the Enhanced Opportunities Fund now, it's about 7% in US Treasuries, and specifically long-term Treasuries. You know, we want the benefit of the capital upside.
Very good investment idea. And we've seen in the past how global bonds can actually give you double-digit returns in dollars. So who knows? Gentlemen, I can see a clock flashing on my side, a timer. So everything is turning red. Unfortunately, we're going to have to cut this conversation short. There's so much more to discuss here. I'm not going to ask you your views and outcomes with Trump and Ramaphosa. We'll all have to wait and see. We can't speculate on that. But holding thumbs.
Make for good TV tonight. Yeah.
Is hope a strategy? I don't know. Gentlemen, thank you very much for your time this morning, and to our audience as well. Thank you very much for joining. I did mention already hedge fund webinar tomorrow morning. Please join. And then next week, Wednesday, we're going to have a panel discussion on SA fixed income and bonds, and continuing some of these conversations. Gents, thank you so much to the BCI team, our audience. See you. Well, I won't see you Thursday, but I'll see you next week, Wednesday. But please join tomorrow. Thank you.